So I was giving you these transactions and how informal way of doing accounting. Again, reiterating that it is an informal way. Do not claim it to be a formal way. And typically you do not put transactions entries directly into the balance sheet. And therefore, none of us, whatever we are doing, makes any sense to anyone who is in accounting. It's just for your understanding and appreciating the concepts that are involved. Okay. So that's the only purpose. So we were looking at this particular transaction where Rohit essentially had sold the stock of cement that he had bought at 10,000 rupees, and that then he sold that at 12,000 rupees. So we were looking at how it would affect the balance sheet of the company, right? So naturally there was a cash transaction. So there's an increment of cash of 12,000 rupees. So the total cash now is 127,000. The stock depletes and there is a zero of the stock now. So the total assets become 152. Corresponding to that, there is something, a new entry in the balance sheet, which is the retained earning, which is the additional profit of 2,000 rupees, which so far has not been settled to the shareholders or whatever, right? So the total balance sheet of the liability side is also the same amount, 1,52,000. We're looking at this. Now, how does a T ledger captures these transactions is something which we were discussing. So, cash account. What happens to the cash account? It's an asset type account. What happens to that? There's an increase in asset. There's an increase in cash by how much? 12,000 rupees. So that goes on debit or credit? It goes on debit side. Then there is a sales account, which is essentially a new type of account. You don't see this entry in the balance sheet. But this is where this process fails. Precisely this is where the process fails, because typically the heads, the account names on these accounts are pretty much standard accounting practices. Some of them find their way into the balance sheet, some of them don't find their way into the balance sheet. As I also mentioned, because once you make the T ledger also goes, some of those entry goes to directly the P&L, profit and loss statement, and only some of those entry make it to the balance sheet. And therefore, you do not find a lot more information in balance sheet, but lot more detail in the T ledger side. So this is a sales account, which is of income type, right? What is happening to income? Increasing by how much? 12,000. Increase in income goes on what side? Credit side. So this is how the entry looks like. So this particular transaction is a little bit complex transaction to handle from a T ledger's perspective. So what do? They create the two entry procedures. T5A, there is a sales income of 12,000 rupees. It's a cash type, so there is a debit side of it. But then there is an equivalent credit entry, which is the T5A through cash 12,000 rupees. Right? This is making sense. But there's something also happens to the stock. Right? Stock is depleted by how much? 10,000 rupees. So that is recorded, this whole transaction is recorded into T5A and T5B types. This B is a new account, which is cost of goods sold. Again, this is a standard way to report COGS numbers. Every company will report COGS, right? That's the kind of cost of goods sold. That is coming out to be 10,000 rupees. Cost of goods sold is essentially an expense. An increase in expense goes on debit side. So this entry on the debit side. So this is how, again, we are not going to go too complicated about this, but you also have to remember that balance sheet is an aggregated statement. It will not have as many details. Sometimes you just put net effects of that, but T account, some of the two entries of T account will go to profit and loss statement. So those entries are much more detailed, and only handful of them finally make it to the balance sheet, and only the net effect is visible in the balance sheet, but the details are lost. but this is how you capture the details of such complex transactions. So again, the principle of debit versus credit is always maintained. Your total assets and total liabilities are still same. These are standard way. Again, by comparing the cost of goods sold and the income, you will be able to make a profit and loss statement using the T ledger's entry. Just to make sure that people know that these transactions are related, this is how this T5 A, B, C kind of a abbreviation is created. So they know that transaction is same, but these are multiple parts, and then people know that you have to look for more entries to find the net effect. Okay. So this is how accounting process. It can become complicated. You can easily imagine if there are a lot more transactions like convertibility happening in a single transaction, your balance sheet will reflect only the net effect. But in the T ledger, you will have multiple of these entries pointing to each other, and therefore your total debit and credit will always be equal. Okay, make sense? Right. So using this information, I also told you last time that there is a process called closing of T account and then making initial trial balance. I'm not showing you the formal closing process right now. We will again look into it details. But essentially, what happened from the transaction between July 1 to July 5? The summary of this is here. Total sales was 12,000. Your expenses, materials were 10,000. Your profits were 2,000 rupees. Right? So out of this, this is your profit and loss statement. The net profit then goes to your balance sheet in terms of your augmented cash account and in terms of your augmented retained earnings account. Right? But this sales and expenses, these details finally do not go to the balance sheet. Only the net effect is visible in the balance sheet. Okay? Simple example, but at least I hope you got some idea about the double accounting principles and all. Today, we will just cover another such case, and then we'll see if I can go to the book or not. Okay? So now Rohit has married already so fast, 2,000 rupees profit, and he is marrying already. Problems with startup guys. So on July 10th, Rohit got married on his schoolmate. Rest of the July, Rohit was holidaying only on 2,000 rupees. First profit, Christmas celebration. But we wish them best, of course. So now Mr. and Mrs. Rohit, they start a company together. Right? They are both entrepreneurial, and that's good. You find the partner like that. On August 1, Rohit put 50,000 in cash as capital and persuaded his wife to give an interest-free cash loan of 75,000 rupees. Rohit is quite smart. He himself put only 50,000 as a capital. Okay? Persuaded wife to give cash, the interest-free cash loan of 75,000 rupees. Slight difference between loan and capital amount. I also discussed this yesterday. This is something called a debt versus equity. What happens in debt is the first person to get the payment out of the profit is the person who pays for the debt, right? But debt cannot be paid more than the original amount. If a bank decides that I'll give you 70,000 loan whatever and this much interest rate in this much period, then bank's total cost that we will finally recover is whatever the time value of money, let's say 75,000 rupees out of, but that's the maximum that bank will get out of it. If the company ends up making, let's say 2 lakh rupees profit, all that remaining profit is for the equity holder. So equity holders take more risks. Yes, in the case of company goes bankrupt, whatever, bank has the first access to their company's assets. But there is no upper limit for equity holders to gain profit. But banks or debts usually have an upper limit to gain. They cannot go beyond what they originally committed for, essentially. So this is a high risk, high reward. Equity is typically high risk, high reward kind of a investment. Now, as an investor, you could see, of course, this is between the couple. If Mrs. Rohit is okay with this, it's fine. Otherwise, you try to make a partners on an equal footing. You will actually see that this will also happen, especially again in Shark Tank. A lot of time people do not get the deal because the cap table, something called a cap table, is not balanced. And what cap table means is that people who are putting effort into the business, they are not of equal high risk, high reward kind of a portion on that particular company's equity structure. And that creates rift later on, right? For example, a person is doing all the ground execution work, but 80% of profit is going to somebody else. So the motivation in the long term is not aligned with the company's vision, and therefore this is a kind of a risk. So you need to have a proper distribution of risk also, risk versus reward also, to people who are originally investing the money in the business, because more or less everyone is taking some sort of a risk, right? So again, just to give you a slight idea of how in the real world this is an important concept of who is the equity holder, who is giving the money as a loan. Ultimately for company, all this money could come as a cash, but in terms of payment back, this has huge impact, and it can actually affect the long-term sustainability of a company also. If founders split up because of their money-related expectations are not matching, then that's also a risk to the company, right? Because a team is important for driving the business in general. So in here, let's come back to Mr. and Mrs. Rohit company. Transaction wise, 75,000 plus 50,000. So cash account gets augmented by 125,000. The total closing balance and the total assets are 125,000, right? Capital is 50,000. Loan is 75,000. The total of liability side is still 125,000. Okay, makes sense? This transaction is clear. Transaction 2. On August 3, Mr. and Mrs. Rohit company bought office furniture worth 10,000 rupees, paying cash. What happens? Which assets? Cash and furniture. Stock. If they are in the business of selling furniture, then this furniture is stock. If they are not, perhaps it's a property that they need in order to do the business. Rohit and Mrs. Rohit needs an office to sit. Otherwise, they can't work. So that's the kind of, it's called as company's asset. You might have seen, even in IIT, we are a bit lazy, but at least in a lot of colleges or anywhere you go, you will see each table will have a label put on it, and each chair will have a label put on it. Each computer will have a label put on it. That's the way of accounting things. That's a number, that reference number that gets generated, that this is an asset belonging to a particular project or a particular department or a particular institute. And that is an accounting procedure. You need to do it. It's not like a company is deliberately trying to take account of how many chairs are existing and all, but they need to show it in their balance sheet. That's why all these assets are labeled sometimes, right? So in this particular case, of course, there is a cash depletion by 10,000 rupees, and there is a furniture, which is a new type of asset. Actually, furniture should come on top, not at the bottom, because furniture is less convertible. So this should come here. This is a mistake in here, but good. I like the mistakes. It allows me to teach the concepts well. Any change in the liability side? Nothing, right? So the total capital and the loan is still there. It becomes 125,000. The only transaction that is happening is the convertibility of the assets. Okay. August 3. Rohit bought 50,000 worth of bricks on credit, agreeing to pay the seller in 2 weeks. What happens now? What are the assets getting affected? Cash? Any change in cash? Yes? No? How many yeses? 2 yeses. How many no's? Yeah, more than 10. How many? No opinion? Or still not sure what's happening? Okay, we'll deal with it. What are the other assets? Stock, which will be essentially your brick as a material, right? Increases or decreases? Increases. All agree unanimously? All fine? Different opinion? No? Okay. So this is increasing. What other assets are there? Sorry? Accounts payable. Is it an asset? It's a liability. Increases or decreases? Increases. Any other thing? The total asset and total liability, is it increasing or decreasing in this transaction? Both will increase. Okay. So this is the summary of what your understanding is. Let's look at this. Cash, no change, because you have not paid the money yet. So no change. Again, this is in a wrong order of convertibility. Pardon me. Furniture is an asset type, increases by, this has to be 0 here, this has to be, so ignore these mistakes, don't get confused. Okay. Stock. No, furniture we already bought. Okay, sorry. I've done this example so many times. Getting confused what's happening. Stock, 50,000 increases. Bricks is the total assets down becomes 175,000 because there is no change in cash. If you would have just bought the amount using cash, the total liability would not change. It's just a simple convertibility transaction. So, you see, if you are doing business on credit, your company's total assets are going up. That is a one way to inflate. You imagine the scale. If you are borrowing, doing things on loan, that's one way to really show, hey, your company is really big. Because your asset size in general tells how big the company is. Also is some sort of an indicator of what could be the market perception about your company's worth and all, right? Capital, loan, the creditors, which is the accounts payable in this case, which is the creditors, also goes up. Yes. Yeah, so that's a principle of accrual. But here the cash has not gone out of the system yet, right? We are showing the creditors as 50,000. No, that's about profit and loss related thingy. This is, transaction has not occurred. Cash has not gone out of your system. You are recognizing that you need to pay to your creditors. That is immediately getting reflected in your cash in the balance sheet. But cash has not gone away from your system. You technically still have 2 weeks to do whatever you want to do this with this cash, right? And that Hansal Mehta case, whatever that, what was the TV series? Scam 1992. This is precisely what they ended up doing. They used to borrow, they used to transact between banks, and bank would give them 15 days period to settle the transaction. So they borrow money from one bank, and in the next bank they have to pay 15 days later. And they started using this money to invest in stocks, and the money's volume was so huge that the profits that they earned was substantial even in just 15 days. They would put back the original money, take the profit. So, can happen. They are recognizing here. Creditors, they are recognizing. The moment they see that there is a account transaction happening, it's reflected. But your cash is not depleted. So, it's true. Both the principles are still okay. We are recognizing them properly. Right? Transaction 4. Rohit's luck still held. Brick prices went up sharply since government banned the brick kiln in Tamil Nadu. I don't know why, but yeah, environmental concerns. Rohit sold his entire stock on August 15 for 60,000 rupees. The buyer promised to pay in a week. Now the buyer is promising to pay in a week. What happens? What all transactions are getting affected here? What happens to your stock? Decreases? Everyone agree? What happens to your cash? No change. 100% people. No change. What happens to your any other stocks getting affected? Any other assets getting affected? Creditors getting affected? Creditors getting affected or debitors getting affected? Debitors are getting affected. This is your accounts receivable, right? Total asset and total liability goes up or goes down? Goes down. Okay. Cash, no change. Furniture, no change. Stock becomes 0. Debtor become 60,000. Total assets. What was the total assets before? So, what happened to goes up, goes down? What happened to the 10,000 profit? That is part of your, at least you have recognized it. You have to pay it back. The asset and liability increases. Right? Your capital, no change. Loan, no change. Creditors, no change. Retained earnings. The profit kind of a statement that we saw is shown as 10,000 now. This is where, this is your new entry, which is the account payable or account receivable. The creditor could be the account payable. So see, again, doing business on credit helps you inflate the assets and liability or the total balance sheet to a certain extent. So the absolute numbers typically should not guide you your investment decisions. You should, therefore, a lot of people rely on different type of proportions. For example, how many of these are your fixed assets versus short-term assets, the ratio of them and things like that. So the interpretation of these numbers is slightly more complex, but they just do not rely only on the total assets and total, because the composition of assets also has a very important role to play in whether a company is likely to make profit or not, kind of a thing, or is going to be a long-term sustainable or not, right? Transaction number 5, the brick purchaser turned out to be reliable, thank God, and paid 60,000 promptly on August 22. Rohit, who had been quite nervous, heaved a sigh of relief. Of course, whenever you get paid, it's a little bit relaxation that, yeah, this money has come. So that's the point. The risk is always there, that once you recognize it on your books, this money may not come. And in that case, you will finally go on a negative side of it. But you recognize the transaction as soon as it occurs. Essentially, that's what we have done here as well. Oh, what happens to this? Cash changes. What other asset account changes? Debtor changes. Anything else? What happens to the creditors? No change? Or right now we are not reached to 2 weeks. This is August 15, this is August 22. When did you buy the bricks? August 3. So August 3, 2 weeks. It's past. So Rohit is playing the game, huh? He's taking money, but he's not paying the money. So we don't have the information on that right now. So of course, the 2 weeks could be whatever is given in the earlier information. The transaction information is not with us right now. I should ask Rohit about this. What is it doing? So, but yeah, are there any other change? Total assets, total liabilities? Goes up, goes down? Same? Okay. Cash plus 60,000. Furniture still 10,000. Stock 0. Debtors become 0. The total remains 185,000. Rohit has not yet paid to the creditors. Still shows in your account. Retained earnings are 10,000 rupees. Okay, all with me so far? Rohit, under pressure to keep his word now, after the date has passed, that his debtor had done so, paid the amount due to the brick supplier on August 23. What happens now? Cash decreases. Any other change on the asset side? What is the liability change? Creditors. Anything else? Total assets liability decreases back to 135,000. Right? So 175 minus 50, 120. Furniture, stock 0, debtors 0. Your creditors become 0. Retained earning 10,000. Make sense? Again, reminding you, in real world, you do not make transaction directly in balance sheet. Therefore, all this game will not happen. This is just to show you the concept. Ultimately, if you put the balance sheet in a month period, you might have just a retained earning increase and some increase in cash, kind of a net effect that will be visible. Right? So, of course, really, if you want to know what's happening, you need more information about the T ledgers and all. But T ledgers are typically not in public domain. They are balance sheets, company disclose. Financial statements, company disclose. But all these internal audit accounting, this is not in a public domain knowledge. Yeah, they might have a independent auditor's report, which they generate, and the auditors claim that yeah, all things went well, and that's the proof that okay, everything is going good. But yeah, typically when you are trying to invest in a company, if you are a big enough investor, you can ask them to reveal all these things. But in that case also, there is a confidentiality clause. Just because you know the information, you can't reveal that information about a private company to anyone else either, right? So that's also financial related issues. But 10,000 profit, Mrs. Rohit also deserves her share. So what about me? Said Mrs. Rohit. Now that you are earning a lot, the total 12,000 rupees in 2 months that he has earned, how about repaying my loan? So Rohit, after much thought, paid back 25,000 on August 31 and thought, if I pay the entire loan, people will think that I am an easy target. Because of course, why do you want to keep loan? It's no, the debt or the interest on loan is not as expensive as the equity. So it's better to keep some loan, in fact a good amount of loan on your assets and balance sheet, because you are not actually paying so much for keeping that on your balance sheet. But equity, if you have everything as equity, then everyone wants share of the profit. But in the debt, the total liability is fixed already. It's not proportion to your business anymore. Right? So yeah, what happens here? So Mrs. Rohit gets paid 25,000 by cash. So cash goes down. What happens to the credit side, liability side? Loan goes down by a little bit amount. Is there any change in retained earnings? Yeah, typically could be. Here we are assuming that the entire amount is paid through the cash stock, but it could also be that retained earnings, but retained earnings are only reserved for capital investors. So this is not, sorry, I was wrong. Yeah, retained earnings are only reserved for capital owners. It is not part of the loan repayment. Loan amount just goes down immediately. You okay? You okay? Need water? Okay. You want AC to be turned off? Alright. So the balance sheet on of August 31st, cash goes down by 25,000, becomes 100,000. The total is still 110,000 because you have this 10,000 furniture. Your loan goes down by 25,000. Now the loan amount is at 50,000 rupees. The total liabilities are also 110,000. Make sense? So your company inflated, now coming down a little bit, but you got money out of it. The whole transaction, you got a 10,000 rupees profit out of it. So the income, what happened? Rohit doesn't like me. Income statement for the period of August 1st to August 31st. Your total sales are 60,000. Your materials cost are 50,000. Your profits are 10,000 rupees. So this is your total income statement or the P&L statement that gets generated for this year. Oh my God, this went so early. So, I told you about the book, Financing, Accounting Made Easy. That has many more cases, that has many more chapters, Will not cover everything in the class, but I will go through that slides now. Or it's basically I'll start teaching using a PDF. Let's see how does it work. But do read essentially these kind of how to take into account the losses, how to take into account the depreciation. They have cases referred to as like blue company, brown company, red company, orange company, like that. They have listed the transactions and they have done the exact same. In fact, I have also taken the example rightly from there, just changed one of their company's name to Rohit's company. It was a little bit easy to relate to. So, but this book has interesting examples of how do you take care of depreciation, how do you take care of losses, manufacturing, the work in progress related work and things like that. How does that get into account? And then there is a proper example of the T ledgers, how to make in them account, how to properly close them. What do I mean by when I say that you need to close a T ledger, transfer the balance, all those things. They have given you formal methods also.